Right, so we are starting with the question, and here is the question Digiwire, which is from the September-December 2019 exams. Okay, firstly, let us look at the requirement and what's the requirement saying. First, it's saying advise the directors of Digiwire company on the recognition and measurement of the Cal Music Company shares received as revenue for the sale of the 3-year license and how they should be accounted for in the financial statement for the year ended 31st December 2006. 2. Royalties which Clam Music Company has agreed to pay in respect of the 3-year license in the financial statement for the year ended 31st December 6. Okay, your answer to A, you should demonstrate or recognition and measurement of the royalties is supposed by the conceptual framework for reporting, financial reporting, and this requirement will give you 9 marks. Okay, so now let us move to the scenario. Back to the scenario, and what's the scenario saying? Let us look at that. Digiwire company has developed a new business model whereby it sells music license to other companies which then deliver music to consumers. Okay, the revenue sales of 3-year license. Digiwire company has agreed to sell Clam Music and Invested Technology startup a company a 3-year license to sell Digiwire company catalog of classical music to public. This catalog contains a large section of classical music, which Digiwire company will regularly update over the 3-year period. Okay. Um, as payment for the 3-year license, Clam Music company has issued shares to Digiwire company, right? Digiwire company equivalent to 7% shareholding voting rights are attached to these shares. Digiwire company received the shares in Clam Music Company on 1st January 6, which is the first day of the license term. Digiwire will also receive a royalty of 5% of the future sales of Clam Music Company as additional revenue for the license. Clam Music Company valuation and revenue on 1st January 2006 was valued at between $4 to $5 million by professional valuer who used a market-based approach. The valuation was based on the share price of the controlling interest in the comparable listed company. For the financial year end of the 31st December X6, sales of the classical music were 1 million. Okay. At 31st December, further share valuation report had been produced by the same professional valuer, which indicated Clam Music Company was valued in the region of 6 to 7 million investment in 4D company. Now this one is not relevant to the question. So get back to our answer sheet over here. And what we will say, see, IFRS 15 IFRS 15 revenue from contracts. Customers requires that non-cash consideration received should be measured at the fair value of the consideration received. Okay. The fair valuation of shares in an unlisted startup company is problematic. However, IFRS 13 Fair value measurement. Advice on how to measure. Unlisted shares. It sets out three approaches. Such as the transaction price, paid for identical, or similar instruments of an investor. But do the income approach. The income approach, for example, using discounted cash flows and the adjusted net asset approach. Uh, so now we will connect with the scenario, and what we'll say in this case, see, now this is with the reference of scenario. In this case, the market approach has been used and the range of their values is significant based upon the based upon the professional valuation report. The range of fair values for a 7% holding of shares would be $280,000 to $350,000. $7 of $4 to $5 million at the rate of contract. And $420,000 to $490,000. That is 7% of 6 to 7 million. $1 billion. Okay. At the year end. As a fair valuation is based upon a similar listed company and is based upon a controlling interest and is based upon a controlling interest. A discount on the valuation of the share on the valuation of shares should be applied to reflect the lack of liquidity and inability to participate in a Digiwire policy decision. Right? Further, what we'll say, next heading is claim music, company share valuation at 31st December 2006. Equity investment second, yes. The second, yeah, no. Equity investment in scope of IFRS 9 should be measured at fair value or in the statement of financial position, which gains and losses on remeasurement recognize in profit or loss. Profit or loss, okay. If an equity investment is not held for trading, an entity can make an irrecoverable election at initial recognition, measure it at fair value to other comprehensive income. With only dividend income recognized and profit or loss. Right? So far, so good. Now, let's move ahead to the part two of the questions, that is related to the royalties, revenue, royalties. Right.